Politics and economics are jikumane. US stocks and FX are jikumane.
Welcome to the Deep Dive. We're your shortcut to getting truly well-informed. Today, we are plunging right into the swirling currents of the U.S. stock market. It's an arena really being shaped by two massive forces right now.
Okay.
You've got the Federal Reserve's money policy on one side and the, relentless surge of the AI boom on the other. Our mission today, take a whole stack of compelling sources, market outlooks, breaking news from, key economic events, deep dives on specific companies, even some core academic research, and just boil it all down. We want to give you those crucial nuggets for a clear, well-rounded understanding.
Exactly. We're really looking to cut through the noise for you. We've pulled insights from big financial players like Franklin Templeton, Business Insider, Nomura Research Institute, Bloomberg Securities, IG Securities, and we're layering that with perspectives from economic commentators, academic studies too. Some really interesting stuff from Doshisha University, actually. This deep dive, it should help you grasp not just what's happening, but crucially, why it matters for your portfolio and, what signals to watch for next in these, fast-moving markets.
All right, let's kick things off by unpacking the latest. The first half of 2024, it was mostly about that huge rally in the big tech stocks.
The Magnificent Seven.
Yeah, exactly. Your Apples, Microsofts, NVIDIAs, all fueled by that initial kind of explosive AI hype. But the Federal Reserve, the FRB, they kept interest rates pretty stubbornly high.
Right.
That 10-year Treasury yield was hovering around 4.5%, mostly because inflation just wouldn't quit.
Yeah, persistent inflation was the key phrase.
So it meant that outside those tech giants, broader U.S. stock growth, pretty modest, really.
And that really sets the stage perfectly for the pivotal moment we just saw. Just a few days ago, August 23rd, 2025, Fed Chair Powell gave his big speech, the Jackson Hole Symposium. That annual gathering out in Wyoming, it's super critical for central bankers globally. Think of it like an intermediate assessment between the official FOMC meetings. It often signals where policy might be heading, gives us clues about their thinking.
And what a speech. The market anticipation was just incredibly high, wasn't it?
Oh, absolutely.
Earlier that week, those July FOMC minutes came out, August 21st. And they painted kind of a mixed picture. Some officials were, pretty worried about inflation expectations, maybe getting unanchored, and about high asset prices. But others were suggesting rates might not be that far above neutral levels. And there was even that rare dissent, right? Two governors actually pushed for a rate cut. You don't see that every day.
Exactly. And what's fascinating, really insightful here, is how fast the story can change.
Yeah.
Because despite those inflation worries in the July minutes, the U.S. employment data for July, which came out after that meeting, importantly, it showed much lower job growth than anyone expected.
Okay.
And significant downward revisions for the previous months, too. That unexpected weakness in the job market, it definitely shifted the Fed's perspective.
Yeah.
Gave them, new data points to chew on.
So with all that swirling, what did Powell actually say at Jackson Hole that got everyone so stirred up?
Well, he hinted very, very clearly, almost explicitly, you could say, at a 25 basis point rate cut coming up at the September FOMC meeting.
Quarter point.
A quarter point, exactly. He mentioned, and I quote, changes in the balance of baseline outlook and risks. He also talked about watching the unemployment rate and U.S. employment market strength, which had started showing his word weakness. That weakness made policy adjustment necessary, he implied. It's pretty much exactly what the market was listening for.
And this is where it gets really interesting for your portfolio. The market reaction, wow. Immediate.
Dramatic.
Instantaneous. U.S. stock indices surged like over 1.5% across the board. S&P 500 up 1.4%. The Dow soared 1.7% to a new record high. NASDAQ climbed 1.7%. And the 10-year Treasury yield dropped quite a bit, settled around 4.26%.
Right.
Investors basically just immediately priced in a much, much higher chance of that September rate cut. It went from about 73.5% probability before the speech to over 87% after.
That's a huge jump in expectations.
Yeah.
Really reflects renewed optimism, or at least relief.
And it's probably worth adding just a little bit of context here. This all happened while there's still that ongoing political pressure from former President Trump,
Yeah, that background noise.
He's been very vocal, demanding rate cuts, even criticizing Fed officials. So it kind of inadvertently highlighted let's call it a hidden theme of Jackson Hole, central bank independence.
Right, keeping politics out of monetary policy. It's something they always try to reaffirm at these events. It's a good reminder of all the different forces at play. So, okay, a rate cut now looks pretty likely for September. What does that actually mean for you, the investor?
Well, historically, the really critical factor isn't just the rate cut itself, it's the bigger economic picture, the environment that follows in the months after. The economy's trajectory after the cut, that's really paramount.
That seems to be the key takeaway, doesn't it?
Yeah.
Looking back the last, 6 Fed rate cutting cycles? So like 89, 95, 98, 2001, 07, 2019. U.S. and Japanese stock markets, they generally move together for about 6 months after that first cut. But here's the crucial insight. If the economy tipped into recession within those 6 months, stocks usually fell.
But if they managed a soft landing, avoiding recession, then stock prices tended to rally. So the ultimate direction for your portfolio could really depend on which path the economy takes.
And if we are heading for that soft landing, well, a rate cutting cycle usually means lower borrowing costs for businesses. And that has a pretty profound effect, right? It makes their future profits look more valuable today, which helps support higher stock valuations. So in that kind of environment, you'd expect maybe a broadening recovery, something beyond just those mega cap tech stocks that have been leading the charge.
Okay, so if we get that broadening recovery, which sectors then should investors be watching most closely?
Well, typically you'd expect those interest rate sensitive growth stocks to get a nice tailwind, especially companies in, say, the AI data center space. Small cap stocks too. They often have higher borrowing costs, they're more sensitive to economic shifts, so they tend to outperform large caps when rates fall and the economy's okay.
Makes sense.
And also, your cyclical sectors.
Yeah.
Things like industrials, materials, consumer discretionary. They could benefit from better economic sentiment, maybe more consumer spending if things stabilize and expand.
Let's maybe make this concrete. Take a company like Applied Digital, APLD. They're big in AI data centers. A 0.25% rate cut, that directly saves them maybe, about $1 million a year in interest?
Yeah, roughly. A nice little savings, sure.
But the real impact for growth companies like APLD, it's much bigger than just that direct cost saving, isn't it?
Precisely. Yeah, for APLD and similar high growth outfits, the rate cut is more about what some people call the AI demand and investor sentiment boost effect.
Yeah.
It significantly improves their financing conditions for future projects, right? Makes their future cash flows seem more valuable and just makes them generally more attractive to investors looking for growth. So, short term, you might see sharp rallies just based on that expectation. Longer term, though, if the Fed actually enters a sustained rate cutting cycle, and if that lines up with their big data centers coming online in 2025, 2026, well, that could be a really powerful compounding tailwind for the stock and, the whole sector.
And this AI boom has this fascinating ripple effect, too. It goes beyond just the direct financial stuff. Like the explosion in data centers needed for AI, that means massively increased electricity demand.
Huge demand, yeah.
The U.S. Electric Power Research Institute, they actually project data center power use could jump to between 4.6% and 9.1% of total U.S. electricity by 2030. That's a huge leap.
Yeah, it is. And this highlights an often overlooked opportunity, perhaps. Utility stocks.
Utilities. Interesting.
Yeah, as of late June 2024, the U.S. utility sector's valuation was relatively low, around 16.7 times earnings, which is, quite a discount to the broader market. And these companies, they stand to benefit directly from that surge in power demand. It could signal maybe a broadening of market focus beyond just pure tech plays towards the infrastructure that actually supports AI.
Speaking of AI, that boom is clearly still the dominant theme for the U.S. market in the second half of 2025, right? It's pushing IT infrastructure spending to record levels.
Oh, absolutely. You've got the big tech players, Meta, Microsoft, Alphabet, Amazon. They're collectively planning over, get this, $300 billion in AI infrastructure investments this year alone.
Wow.
That scale of spending, it's just a massive driver for the whole AI ecosystem. Chip makers, software, everything, they're essentially building the future right now.
And the key barometer for this whole trend, the company everyone's glued to, is NVIDIA. Their Q2 earnings are coming up August 27th.
That's the big one.
What are the really key things investors should be looking for in that report?
Okay, 2 main points of focus for NVIDIA, I'd say. First, their data center business.
Yeah.
It's now about 90% of their revenue, which is incredible. It's expected to show continued, really robust growth. Analysts are forecasting something like a 56% year-over-year increase to over $41 billion just for Q2.
$41 billion.
Yeah. The demand for their high-performance chips, like the new Blackwell series, it just remains immense. They're still way out front.
Are there any clouds on the horizon, any significant risks or headwinds NVIDIA's facing despite that growth?
Yes, there's one major area of uncertainty: their China business. Export regulations are already expected to cost NVIDIA about $8 billion in Q2 revenue.
$8 billion, okay.
And there are even reports suggesting NVIDIA asked suppliers to halt production of their special China-specific H20 AI chip. Apparently, the Chinese government is encouraging local companies to avoid it. So that adds significant complexity to their outlook. Could temper some of that massive optimism.
Right. So the market's going to be weighing NVIDIA's ability to keep up that high growth despite these geopolitical challenges.
Exactly.
A strong earnings report and optimistic outlook for Q3 analysts are projecting over $53 billion in revenue there. That could push the stock higher, maybe challenge that $190, $200 range.
Potentially, yeah.
But any sign of growth slowing, especially if it combines with, say, fading hopes for Fed rate cuts, that could trigger a sell-off.
And it wouldn't just hit NVIDIA.
No, it could impact the other AI4 stocks, Meta, Alphabet, Amazon, and maybe pull down the whole NASDAQ. Beyond NVIDIA, though, we are seeing other companies really making strategic moves to capitalize on AI.
Oh, definitely. Look at Broadcom. They just reported record revenue. AI chip sales topped $4.4 billion in their Q2, and they expect AI revenue to hit $20 billion this fiscal year and maybe $30 billion next year.
Mm-hmm.
Their focus is clearly AI networking and integrating VMware. And Hewlett-Packard Enterprise, HPE, another great example. They reported strong AI system orders and sales in their Q2, and they just closed that Juniper Networks acquisition, specifically to boost their AI native networking stuff. Salesforce, too, making big moves. Yeah. They're buying Informatica, the data management firm, for $8 billion. That's a clear strategic play to beef up their AI agents and data cloud. These aren't just, speculative bets. These are calculated moves to integrate AI deep down.
And what seems really important here, as these companies navigate this whole boom, is the quality of growth.
Yes, absolutely.
With expectations already so high, priced into the market, investors are getting really selective. They want solid execution, real results, not just, continued hype.
And, to really get a handle on these market dynamics, how monetary policy actually hits your investments, it's maybe helpful to just briefly touch on the academic research. How does it actually influence stock prices? Because it's not always quite as straightforward as it might seem. Economists have been looking at this for decades.
Yeah, you might instinctively think financial policy affects the economy mainly through, lending rates, or just the general money supply.
Those are definitely two of the traditional channels. Economists call them the money view and the credit view. But there's a third channel, often underestimated, but crucial, the asset price view. This idea says short-term interest rate changes directly hit asset prices, stocks, real estate, exchange rates, and that then influences overall demand. How? Well, by making people feel wealthier, which might boost consumption, or by changing company balance sheets, which affects investment.
So academics have actually tried to measure this link, put a number on how monetary policy changes move stock markets.
Oh, absolutely. Early studies, like one by Thorbeck back in 1997, found that a significant positive shock to the federal funds rate, basically a surprise rate hike, could knock about 10% off annual stock returns. And interestingly, smaller company stocks seem to be more affected, showed higher sensitivity.
What about those unexpected policy moves, the ones the market didn't see coming?
Right, that's key. Research by Bernanke and Kuttner in 2005 looked specifically at that. They used market data, like federal funds futures, to isolate the surprise element of a rate change. And they found that an unexpected 0.25% cut in the Fed funds rate typically led to about a 1% increase in stock prices.
Wow.
And it's pretty notable, right, that Ben Bernanke later became Fed chair himself. It just highlights how deeply these ideas are understood, and maybe even used at the highest levels. And even more advanced research using fancy econometrics like work by Rigobon and Sack in 2004 suggested that maybe those traditional methods actually underestimate the impact. Their work indicated a 0.25% policy rate hike could cause the S&P 500 to fall by 1.7% and the NASDAQ by 2.4%.
So tech stocks being more sensitive again?
Exactly. A significantly greater sensitivity in those tech-heavy indices. So all these studies together, they confirm that yes, monetary policy shocks have a real, statistically significant, quantifiable impact on stock markets, especially for tech and small cap stocks, which seem more sensitive to borrowing costs and future growth expectations.
So putting it all together, you've got this really fascinating interplay going on, a likely Fed rate cut offering a potential tailwind. seemingly unstoppable force of the AI boom driving massive investment.
Right.
And then this nuanced historical and academic background telling us that it's the economic outcome of those cuts specifically. Can we get that soft landing that really dictates the market direction for your portfolio?
Yeah, that's a good summary. This deep dive, I think it's highlighted that while rate cuts can definitely boost investor sentiment, maybe favor sectors like growth and small caps, the ultimate impact on your portfolio really hinges on whether the economy pulls off that tricky soft landing. And meanwhile, the AI boom, it keeps presenting these immense opportunities for companies, for investors, but it also demands a really critical eye now for that quality of growth, for solid execution, especially in key players like NVIDIA as this whole landscape keeps evolving.
It really leaves us with a kind of provocative thought, doesn't it? In a world where everything's so interconnected, where a central banker's carefully chosen words can shift trillions of dollars, and the new technology like AI is just reshaping entire industries. How much of your investment success is actually about picking the absolute right company versus correctly reading those bigger economic and policy tides? Something to definitely ponder as you navigate these, well, exciting but complex markets.